Sarosh, who will be today's moderator. Thank you.
Thank you, Rafael and Dominic, for organizing this webinar series. So today's topics for the webinars are, first, are Swedish house prices too high? Why the price to income ratio is a misleading indicator. And second, political party affiliation and inflation expectations. Let me quickly go through the format of the webinar. So the total time for the webinar will be 45 minutes. There are 15 minutes each for the two presentations, followed by 15 minutes for the Q&A session. For the Q&A session, please write your questions in the Q&A space that you can see on the webinar. I'll be monitoring that space and then collecting all the questions. You can start writing questions during the presentation and don't have to wait for it at the end. But the actual Q&A will happen at the end of the two presentations. This session is being live streamed on Sibra's YouTube channel and is also being recorded. And the recording will also be posted later. The usual disclaimer applies. So the views of the presenters are strictly those of the presenters and not that of the Sibra or any affiliated organizations. And participating in this webinar doesn't mean an endorsement of the views of the Sibra or the participating institutions. And now let me introduce the two speakers. First, Lars Svensson, who is an affiliated professor at Stockholm School of Economics, will present on the topic, are Swedish house prices too high? Why the price to income ratio is a misleading indicator. And then Carola Binder, an associate professor of economics at Haverford College, will present on the topic, political party affiliation and inflation expectations. All right, so let me just hand it over to Lars.
Okay, can everybody see my screen?
Yes.
Okay, thank you very much for the invitation. I really appreciate it. And you see the title there, you see my email address. If there is anything that is unclear or unconvincing or even wrong, let me know it by mail unless you raise it as a point here. And I mean, my experience is that often criticism, negative criticism is more productive than praise. So don't be shy about criticizing me if there's something that doesn't fit. Well, and you also see my web site there, where the latest version of the paper is available. So, are Swedish house prices too high? This is part of a research project on just a second here. On indicators of over or undervaluation relative to fundamentals. Overvaluation of owner-occupied housing, houses and tenant-owned apartments. It's really about housing because the data is best for that. So ESRB, the European Systemic Risk Board, they think that Swedish house prices are overvalued by about 55% too high in 2021 Q2. The European Commission thinks that the prices were about 35% too high in 2021. And these things, they affect the ESRB warnings and recommendations on Swedish economic policy, as well as the Commission recommendations. Also, the ESRB assessments, they determine the shocks in the European Union-wide stress tests conducted by the European Banking Authority. So correcting 55% overvaluation, that implies a house price shock of minus 35%. And that's exactly the house price shock Swedish banks suffered in the latest stress test. Fortunately, the Swedish banks did very well and are quite resilient, as the Swedish FSA noticed. But anyhow, I argue that these assessments of overvaluation are arguably misleading, and mainly due to unreliable and misleading indicators that lack scientific support. The misleading indicators are price to income and price to rent ratios relative to historical average, indicators that are used all over the place. They lack scientific support. And in particular, they disregard the crucial role of mortgages, mortgage rates, costs of operation, maintenance, repair, depreciation, for the cost of living in owner-occupied housing. The appropriate indicator, I argue, is the user cost of housing, the user cost of housing services that the houses deliver. This is the actual cost of using and living in owner-occupied housing. This has substantial scientific support in a large housing literature. The user cost to income is a natural indicator of affordability. The user cost to rent ratio is a natural indicator of relative affordability of owner-occupied housing relative to rental housing. That is, with a well-functioning rental market, unfortunately not in Sweden, where we have a dysfunctional rental market due to rent control. So when you look at this, the Swedish user cost to income ratio has fallen over time and was in Q1 2020 substantially below its historical average. This is consistent with the actual Stockholm apartment owner-occupiers' everyday experience. There are lower living costs in owner-occupied housing than the rents in comparable rent-controlled apartments. The UCTI ratio has risen in 2021-22 to reach its historical average due to rising mortgage rates mainly. However, there was probably a preference shift during COVID in favor of larger and better housing. So if you adjust for that, the UCTI ratio is still about 17% below its historical average. This is completely inconsistent with the large overvaluation that the international organizations I mentioned argue in favor of. So here, a summary in one figure. This is price to income, the price of 1 to 2 family houses in Sweden relative to disposable income per capita, net disposable income, and the percentage deviation from a historical average. And you see here that it starts out at minus 40, goes up to around 0 around 2010, and then has risen to more than 40% in 2021. So the issue was housing overvalued by more than 40% in 2021. Then prices have fallen recently. So at the end of 2022, the PTI is about 20% above its historical average. So are we still overvalued by 20%? That's the question. Okay. Importantly, the price of a dwelling is not the annual cost of living in an owner-occupied dwelling. A simple example, suppose you can borrow 100% of the price of the dwelling that you buy, and suppose you get an interest-only loan, no amortization. then the annual cost is just the interest on the loan, not the price of the dwelling. We actually have to distinguish the dwelling, the asset, from the housing services that the dwelling delivers. It's the housing services that are consumed, not the dwelling. So the user cost of housing, the user cost of housing services, is really the sum of the annual operation, maintenance, research, and depreciation costs, the real after-tax interest on the mortgage, the real cost of any housing equity, taxes, possibly a risk premium, and minus expected real after-tax capital gains. Capital gains reduce the cost of living in owner-occupied housing, so they enter with a minus sign. So that's what the user cost of housing services is. Sorry, okay, so here it's very practical to look at the user cost of capital, the user cost as a percentage of the house price. So that is called the user cost of capital. And that is, we have the blue curve here, which is the price to income deviation from historical average. Here we have the user cost of capital measured on the right axis. So you see it goes from 11% in 1997 down to almost 3% in 2021. And recently it goes up to close to 5% because mortgage rates have risen recently. Before they fell, now they have risen recently, and also electricity prices. So the operations cost have gone up. Okay, the user cost is then simply the user cost of capital times the price of the house. And the user cost of income is just the user cost of capital times the price to income ratio. So the red curve here is the user cost to income ratio, the solid red curve. So in 2019 Q4, it was down at minus 33%, 33% below the historical average. So this points to an undervaluation of 33% according to this measure. And then at the end of 2022, it was back to the historical average, plus 1%. So then neither over nor undervalued according to this measure. Okay, but we did have a rapid price increase 2020 to 2021 during the pandemic. Usually during a crisis, house prices fall. Here they rose. And this is really interpreted as a preference shift to bigger and better housing, in particular from apartments to housing, to houses. And here we are looking at the price of houses. There is a nice analysis of the Riksbank in 2021 on this issue, and the phenomenon is observed in several countries. So here I make a simple preference adjusted price to income ratio. I just assume that 25% of the actual price increases were price increases during constant prices. 75% were a change in preferences. And then if you don't like the numbers 25%, one can easily redo it with any numbers. So anyhow, given that preference adjusted price to income ratio, you get the corresponding preference adjusted user cost to income ratio. And that one goes to minus 17% at the end of 2022. So according to this, housing was still undervalued by 17% at the end of 2022. So this is clearly not consistent with large overvaluation. Instead, there is still undervaluation, or if you don't buy my preference adjusted thing, there is neither over nor undervaluation. Furthermore, if you look here, you can see that the preference adjusted price to income and user cost to income, they look approximately like mirror images of each other. And if you look at this, here I plotted the user cost to income ratio and the negative price to income ratio, both preference adjusted. And you see they are highly negatively correlated. The correlation coefficient is -0.8. So the PTI and UCTI ratios give opposite messages. And the user cost to income has a theoretical support in the large housing literature. Price to income has no theoretical support. So for Sweden, price to income is not only misleading, it's actually systematically wrong. Okay, so a few conclusions. There are many details here that I cannot talk about because time is limited. The crucial thing is to calculate its user cost of capital. And there is a detailed discussion of that in the paper, but I don't have the time to talk about that here. So let me go to conclusions. First, I mean, what I'm saying is actually a simple methodological point. I mean, the user cost to income is a natural indicator of affordability of owner-occupied housing. The user cost to rent ratio is a natural indicator of the relative affordability of owner-occupied versus rental housing. In simple models with perfect housing markets, the user cost to rent ratio is actually unity for similar housing. The user cost to income and the user cost to rent, there is an extra I there. They are the product of the user cost of capital and the price to income and price to rent ratios respectively. So that once you have the user cost of capital, it's easy to calculate these ratios. Using only the price to income and price to rent, which these international organizations do all the time, that disregards all the relevant information in the user cost of capital, the financing cost, the operation, maintenance, repair and depreciation, the tax rates, the risk premia, any expected capital gains. If the price to income and price to rent ratios, they would be okay if the user cost of capital would be approximately constant. But as you could see in the previous graphs, there are long trends and considerable variability in the user cost of capital. It's far from constant. So this, I think, is a pretty obvious and uncontroversial point. Actual points is that the user cost to income and the price to income ratios are strongly negatively correlated for Sweden. Correlation coefficient -0.8. So they give completely opposite messages. There seems to be no large overvaluation of Swedish owner-occupied houses. Instead, there has been substantial undervaluation, at least through 2019. And now recently, the UCTI ratio has risen. With the preference adjustment, we still have 17% undervaluation. And also, this is not something that concerns Sweden only. I've started to look at several European Union countries, and the user cost to income and the price to income ratios are negatively correlated for several of the European countries. Belgium and Austria are very similar to Sweden in this respect. Actually, there is a database by the European Commission, the Housing Taxation Database, which actually calculates the user cost of capital. The purpose of the database is to discuss distortions in housing because of taxation of housing. But you can actually use it for valuation purposes. So you can actually easily calculate the user cost to income and user cost to rent. So that is the next thing I'm working on. And then I have a few improvements for valuation assessment, really directed towards the international organizations and ECB I mentioned. Start computing these better measures. And also, I haven't talked about their models, but some of their models are not documented at all. It would be very nice to see that and see also replication kits. Finally, constant user cost and user cost to income or user cost to ratio do not provide a theory of house price determination. In simple theories, they are constant, but we have already seen here that the user cost to income and also the user cost are not constant. So these simple theories are oversimplified and empirically rejected. If you want such a theory, you actually need to take into account a few more things: how housing demand depends on liquidity and credit constraint, transactions cost, and the role of housing payments in addition to user cost. And there is some new papers on that. Okay, that ends my presentation. Thank you.
Thank you, Lars. Carola, please go ahead.
Sure, let me share my slides. All right, hi everyone, I'm Carola Binder and I'm at Haverford College. I'm happy to present this work. It's actually, it's a blog post that I wrote for Brookings, so I don't have a full-length paper on what I'm gonna present today, but hopefully it's still something that is going to be interesting to all of you, and I'll give a little more details than what I put in the Brookings post. But this is about political party affiliation and inflation expectations. So I'm sure that you are all aware that as inflation started rising in 2021, the Fed repeatedly used the word transitory to describe the inflation. This transitory descriptor became quite politicized as the Biden administration repeated the claim that inflation would be transitory, while more right-leaning media tended to mock this claim. And on Twitter, people started using hashtags like Team Transitory and Team Persistent, making it clear that this was really about taking sides. And those sides were aligned, I mean, not exclusively, but at least quite strongly with political party. And you might point out that Powell himself is not a Democrat, but a recent study by Amre Couvet finds that the ratio of Democrats to Republicans among Fed economists is 10-1, and at the Board of Governors, it's about 49-1. And you know, throughout 2021, 2022, many of us economists were following this team transitory versus team persistent debate quite closely. But you might wonder the extent to which this debate kind of made its way to the general public, and in particular, whether the partisan nature of this debate made its way to the general public. So did partisan allies of the president buy into the transitory claim while his opponents did not? And in fact, we can actually see that the politicization of views about inflation was widespread through the general public. As I'll show you, Democrats were almost entirely on team transitory, while the rise in inflation expectations over 2021 and 2022 came almost exclusively from Republicans. So let me just show you a couple of graphs. So this figure is showing you the inflation expectations of self-reported Democrats, Republicans, and independents on the Michigan Survey of Consumers, the mean 1 year ahead inflation expectations. And what you can see is when Obama was president, party affiliation was only asked occasionally, but Republicans had higher inflation expectations than Democrats. And later, when Trump was president, Democrats had higher inflation expectations than Republicans. And then there was a switch that occurred right at the time of Biden's election. So then again, Republicans had higher expectations than Democrats. But what you can see is that that gap really started to widen in 2021. This is showing you the mean expectations, but you see the same pattern if you look at the median instead, if you prefer the median. And you also see a qualitatively similar result with long run expectations. So these are expectations of inflation over the next 5 to 10 years. And again, you see for Democrats, that's the solid blue line, long run inflation expectations actually declining a little bit during 2021, while for Republicans and also for independents, they really start to rise. Okay, so these results that I just showed you are consistent with a small but growing literature on partisan differences in inflation expectations and economic sentiment more broadly. And several studies using US data and one using Australian data show this, this fact that you just saw, that consumers have lower inflation expectations when their party of preference holds executive power. Why is this the case? I think it largely comes from what's known as the good news, bad news heuristic, where consumers simply associate good times with low inflation and bad times with high inflation. There's a really nice paper on this by Rupal Kamdar, who I think is in the audience today, which is really nice. But I think that can probably explain a large part of why we have this really strong partisan association with inflation expectations. There's also some mixed evidence about whether these partisan differences in economic expectations actually translate into partisan differences in consumption. Again, there's a paper by Kamdar and Ray with some evidence on that using Michigan survey data. But these studies were conducted mostly before the Michigan survey had started consistently collecting its respondents' party affiliation every month, and before this big rise in inflation. So what I'm doing is looking a little more into detail about how this gap changed in 2021 and 2022 when inflation began to rise. So I showed you the median and the mean inflation expectations by party. But here I'll show you more about the distribution of expectations. So in this panel A, you see the median and the interquartile range of Democrats' inflation expectations in the last couple of years. And you see that really none of the distribution changes at all during 2021 and 2022 as inflation rose. So really all of the rise in inflation expectations was coming from Republicans, where you see the whole distribution of expectations rise. Similarly, for long run expectations, there's no real change in the distribution of Democrats' expectations. The rise, of course, it's smaller than the short run rise, but it's coming from the Republicans. Okay. This is actually showing you the absolute gap in expectations between Democrats and Republicans for 1 year ahead inflation. And as you can see, there's always a gap, right? But it has really increased as inflation rose. So increased to a gap of around 4 percentage points. The difference between Democrats and Republicans' expectations is around 4 percentage points, which is very large. And to give you an idea of how large it is, I'm going to compare that gap to some other gaps in expectations between different groups that have been studied in the literature. So again, the thick green line here is the difference between, is the gap between Democrats and Republicans' inflation expectations, the absolute gap. The orange line is the difference between consumers and professional forecasters' expectations. We know that consumers and professional forecasters have quite different inflation expectations, but that's about the same magnitude as the gap between Democrats and Republicans. The difference between male and female inflation expectations has been studied quite a lot. Females tend to have higher inflation expectations, but that's actually really dwarfed by this partisan difference, as is the gap between college-educated and non-college educated consumers. One last graph that I'll show you is the inflation uncertainty index by political party. So this index is constructed using a method that's in a JME paper I published in 2017 that uses consumers' rounding behavior on the Michigan survey as a way to construct a measure of inflation uncertainty. And what you can see is that Democrats, Republicans, and independents had quite similar levels of inflation uncertainty, again, until 2021, when the gap increased. So then Republicans, as their inflation expectations increased, they became relatively more uncertain about inflation than did Democrats. So everyone became more uncertain about inflation during the pandemic, but then that uncertainty really declined for Democrats, didn't decline as much for Republicans, and has recently started to converge. I also computed the correlation of median short-run inflation expectations by party group with professional forecasters' expectations. So since 2008, the correlation is about 0.68 for Republicans, 0.65 for independents, and 0.5 for Democrats. If you just compute these correlations since 2016, Republicans and Democrats have about a 0.7 correlation of their expectations with professional forecasters, while for Democrats it's about 0.3. Similarly, if we look at the correlation of consumers' long-run expectations with TIPS 5-year break-evens, another long-run market-based measure of inflation expectations, we see that the correlation is quite strong for independents, strongest for independents and Republicans, and actually negative for Democrats. Okay, so just to conclude, I think there's still a lot to try to understand about the implications of this partisan gap in inflation expectations, really what it means for our ability to kind of accurately measure and monitor inflation expectations, whether people are reporting their kind of true inflation expectations or are using the survey more as like a signaling their vote of confidence for the administration. And we need to continue to study implications for economic outcomes, like are these differences really going to drive different consumption behavior? And think about what they mean for central bank communication and credibility. So what does it say for central banks if they're not able to control the inflation expectations of the group that doesn't share the president's power? Thank you.
Thank you, Carola. All right, thanks again to both the presenters. We're ready to do the Q&A session. Lars, are you still there?
Yes, I'm here.
Okay, because we have a couple of questions for you. So I'll start with a question for Lars. So the question is how you computed expected capital gains, because that tends to be contentious, and are they robust across various measures if several are available?
Okay, the issue of capital gains is actually discussed in some detail in 2 footnotes of the paper, 34 and 35. But the gist of that is that I actually make the assumption that expected real capital gains are zero, meaning that when people buy new housing, they don't speculate in making large capital gains. I think of this as a pretty conservative assumption, because the actual capital gains, the real after-tax capital gains, have been about between 2 and 4% per year up through 2022, depending upon the period when you start. So they have been substantial, but I assume here that they are zero, and people buy housing without thinking of those. Actually, there is some empirical evidence in favor of this from the US. There is a paper by Garner and Verbrugge from 2009, when they find that if they make that assumption for US data, they find that user costs track rents pretty well. So the user cost to rent ratio is pretty stable. They interpret that as evidence that people do not speculate or really assume that, or their behavior can be explained by them implicitly assuming that real capital gains are zero. So I think there is some support. Of course, one can take actual capital gains if you think people have perfect foresight, but they are very volatile, and they really screw up things, and I think it's completely unrealistic that people would have perfect foresight assumptions about these things.
Okay, great, thank you. So let me go to Carola next. So question is, one of the questions is about whether you see similar patterns across other variables like housing prices or interest rate expectations and so on.
Yes, you do see similar patterns across a lot of different measures of economic expectations or economic sentiment. Again, the paper that I mentioned by Kamdar and Ray, they consider a lot of different measures from the Michigan survey, and yes, similar patterns where generally like the economic sentiment is much more positive among people whose preferred party is in control of the presidency.
All right, thank you. Let me come back to Lars. Another question was about what would be the implications of your work for measurement of inflation for the Riksbank, as well as policy implications. I know you've written several papers already on policy implications, but it might be worth talking about it again in view of actual measurement of inflation.
Okay, I mean, when you calculate the CPI in Sweden, you do take into account housing costs, not housing prices, but housing costs. So rents for rented apartments, rent control rents for rented apartments are in there in the CPI, and also some components of the user cost, as I and the literature calculated, name operation, maintenance, and repair. That is in there in the CPI. Also, mortgage costs is there, calculated in a somewhat simple way that is not really the best, but anyhow, it's in there to some extent. So housing costs rather than housing prices enter the CPI, which is the right thing. I mean, the housing services are part of the consumption, and the cost of that is to a considerable extent covered by this in the CPI.
Okay, thank you. So to Carola, this next question is whether we know from your or other work if expertise matters in this distinction. So this kind of partisanship gap that you showed over time, whether that might be smaller for economists or macroeconomists, and whether, I guess, other variables, not just expertise or education, and some other variables might actually be explaining bulk of the difference.
Yeah, I think for sure with expertise, people rely a lot less on things like heuristics for forming their inflation expectations. So if you look at measures of disagreement in the consumer data, they're at least an order of magnitude larger than disagreement in the professional forecasters data. We don't know if the professional forecasters are Democrats or Republicans or a mix, but we're not seeing that that huge gaps, right? We have the gap between Democrats and Republicans at like 4 percentage points for consumers. You would never see two professional forecasters forecasting 4 percentage points apart, right? They're much closer together because they're using the same kinds of models. They're aware of the Fed's inflation target and so on.
Sarosh, may I add
Great.
a thing to my answer?
Yes, about the inflation measurement.
Yes,
Yeah.
I could add that I mentioned that mortgage rates enter the CPI. And actually, this causes a problem, a pedagogical problem for monetary policy, because when you raise the interest rate to reduce inflation, in the short run, housing costs go up and inflation goes up. Of course, in the longer run, it goes down. So in order not to have to deal with that pedagogical problem, the Riksbank actually uses what is called CPIF, which is CPI with a constant interest rate. So they really take out that effect and look at the rest of the CPI. If you understand the CPI, I don't think there is a pedagogical problem. But of course, for most people, they don't understand the difference. And maybe the CPIF is a good idea then. So the official target nowadays for the Riksbank is actually 2% for the CPIF.
Okay, great. So let me, I have one more question for you, Lars, the last one for you. There's a question from the audience on, while it's might be understandable that using flow measures, such as price to income, might be misleading, whether to answer the question, house prices are too high, don't we need to compare the stock against stock measures? So something like discounted value of future income adjusted by the estimated present value of total lifetime cost.
I agree. I mean, price to income is a stock over a flow, and that always is problematic. User cost to income is a flow over a flow. So that makes perfect sense. So one should try to. I mean, you should look at the housing stock relative to the stock of debt. I mean, the solvency of the, I mean, loan to value ratios. I always try to look at stock to stock measures and flow to flow measures.
Okay, great. So final question for Carola is whether through survey or this survey or other surveys, you can measure confidence in the economy, and in particular confidence in the Fed's ability to control inflation, and whether that might be showing up in some of your results. Because early on in the sample, during the QE period, as we all know, there was a lot of worry that QE is going to lead to hyperinflation and so on, but that didn't get materialized. So whether it's kind of related to really confidence in the Fed's ability.
So I mean, there are a variety of different measures of consumer confidence. The Michigan survey constructs its own consumer confidence index using several different responses to the survey questions. And then a lot of research, tries to come up with different ways to measure the credibility of the Fed's inflation target, whether that's how responsive are long run expectations to shorter run shocks, or how much disagreement or how much uncertainty is there in longer run expectations measures. I think though there's a difference between just confidence in the economy and confidence in the Fed or in the Fed's ability to control inflation, because a lot of people, when they're responding to a survey question about inflation expectations, probably do not think about the Fed at all if they know what it is. And we see that when that's part of why we see these partisan gaps, right? If everyone was just thinking about the Fed, I don't think we would see as large of partisan gaps. I think people are just generally thinking about the economy as a whole, and they kind of attribute a lot of how the economy is doing to the president, rightly or not. So yeah, I don't think this is necessarily about the credibility of the inflation target, more about maybe a lack of awareness of the inflation target.
Okay, great, thank you. So we're right on time. So let me thank the speakers again for participating in today's webinar. And there's a webinar next week, so hopefully see you all soon next week.
Thank you.
Okay, thanks very much.
Thank you very much, everybody.